Hello, welcome to our first quarter 2026 quarterly playbook. I'm Sean Anderson, President and Chief Wealth Strategist here at Anderson Financial Strategies, and I'm happy to present to you our outlook for what's going to be happening here this year and what to expect here during the first quarter. So the theme is keeping with the last quarter's theme of partying like it's 1999. We're going with keeping the party going. And as we turn into 2026, many of those same key ingredients to keep the party going remain in place. A high level of economic growth, lower rates, and strong profit forecasts provide a robust backdrop that has refilled the punch bowl for the markets to party on. However, the longer we stay in party mode, we acknowledge that there is the risk that the music stops or the punch bowl gets taken away and bad things start to happen. But that doesn't seem to be happening anytime soon. We would likely need to see an economic slowdown, earnings recession, and a more hawkish Fed before the lights start to get turned off for the markets. And that's the opposite of what the current situation is. Nonetheless, like with everything in life, moderation is key, and it's important to not overindulge. So what's happening? What are those key ingredients? Well, first is the U.S. stock market. As the ball dropped from 2025 to 2026, the economy is ringing in the new year with strong growth tailwinds. Looking at the end of last year, we saw a 3.8% GDP growth rate in the second quarter, a 4.3% growth rate in the third quarter, and the fourth quarter is estimated to grow at a whopping 5.1% as of the latest GDP Now reading on January 9th. Now that also includes that 43-day government shutdown and is also lacking some of the data that's usually released during that period of time because of that shutdown. But based on a $30 trillion economy, that is a very strong growth rate, and that's far above the average of 2.3% since 2000. So a strong economy. We also are having economic data releases come in better than expected. That can be seen as far as the City Economic Surprise Index reading at 14.2, meaning that actual data is coming in better than expectations. And that's been doing so for a little while now and looks to be accelerating. The last piece of our economic ingredients looks at unemployment. And last quarter, we were a little concerned as unemployment was at 4.6%, and we were watching a breach of the SOM rule, which is where the 3-month moving average of unemployment is 0.5% or more above the prior 12-month low 3-month moving average. And so that was something that we wanted to watch. The most recent unemployment rates actually came down though. So unemployment is down to 4.4% compared to 4.5 in November. And the U6 measure, which includes part-time workers that wish they were full-time and those that just stopped looking for jobs because they couldn't find them, down to 8.4% from 8.7% in November. So those are well below their long-term averages, and we think that this natural level of floating unemployment, a little higher, is more in that neutral phase. So we expect good things from the economy this year. And good things from the economy allow the stock market to keep the party going. And the stock market is still the life of the party. Earnings growth was stronger than expected last year. It came in around 13% compared to a historical average of only 7.7. This year, expectations are for earnings to keep the party going with a 15% earnings growth rate. So that is a very, very strong growth rate. And even though we have high valuations because of that high earnings growth, we expect a 10 to 15% upside in the S&P 500, meaning we don't think that the price to earnings multiple is going to expand much. We also don't see it declining much either, or contracting, because we have such a strong growth environment. Other places in the stock market look particularly interesting, such as small cap value, very low valuations and strong earnings growth, and mid cap growth, which actually has the strongest projected earnings growth out of all of the stock asset classes at 27% earnings growth. So while large cap stocks have been the life of the party for a while now, we expect the spotlight to continue to turn towards those smaller areas of the market. Turning over to bonds, the bond market looks poised to continue the party as well. And we see a powerful combination of cooling inflation, a lower rate path from central banks, and generally solid corporate balance sheets, setting up for a very compelling opportunities in fixed income. So policy rates will continue to come down from their restrictive levels. We'll get to that here in a little bit, but we expect 2 to 3 rate cuts from the Fed. Investors can really enjoy equity-like returns in those high single digits for fixed income. Meanwhile, you're also collecting a fairly high level of yield, and the duration benefits when those rates come down are fairly significant amongst most asset classes. So 2026 looks like a year to stay on the dance floor in fixed income, tilting towards high-quality core bonds and selectively embracing those high-yield positions to keep portfolios lively if markets keep the party going. International markets, international assets, both stocks and bonds, partied hard last year and outperformed U.S. assets. And this was in part due to the U.S. dollar's weakness early on that boosted foreign asset returns. The dollar lost about 10% last year compared to foreign currencies. However, the dollar is largely stabilized now with interest rate differentials and trade policy shifts that previously pressured that currency lower no longer in place. When we look at U.S. markets, the U.S. market is expensive, but also is growing at a very fast pace. International markets are much less expensive, but not growing nearly as much, and therefore have identical price to earnings to growth ratios, or otherwise known as PEG ratios, at 1.4. So, as we expected last quarter, it's a 50-50 proposition of where the outperformance is going to be, whether that's going to be internationally or the U.S. for 2026. Now, every party has a pooper, and in this party, real estate has been that party pooper. And it's not because they wanted to sit out, but the crowd just wasn't feeling their vibe. With the exception of data centers, looking at the chart here from NAREIT, you can see relative valuations majorly favor REITs. Despite favorable valuations, though, and operational performance, REITs have been left out of the party for the most part. But we think that this valuation and performance gap creates a pretty good opportunity setting up for patient investors. So what do we think the Fed's going to be doing here in 2026? Well, we would say, keeping with our keep the party going theme, the Fed in this scenario would be the DJ, interest rate policy as the music and vibe, and then inflation in the economy as the crowd. And lately, the DJ's been spinning crowd favorites with rate cuts and the resumption of quantitative easing, which was a surprise back in December, and in a bid to bring down long-term interest rates, especially for home buyers. However, they're expected to tone it down a bit for the first part of the new year. We don't expect any rate cuts until the summer, which is what the futures market believes as well. because the Fed doesn't want to get the crowd too energized, meaning inflation picking up or anything like that. But after all, the crowd's been pretty well behaved so far for quite some time, and PC inflation has been below 3% for well over a year. And we have a robust economic backdrop fueling the mood. So this favorable scenario should allow the Fed to keep turning the music up and let the crowd enjoy the party. So futures markets echo this, predicting between 2 and 3 rate cuts, which is our prediction, mostly starting in the summer. This would be where this would put the Fed into a neutral position, meaning it's neither restrictive nor accommodative. And that would be where the Fed funds rate minus inflation equals 0. So at inflation between 2.75 and 3%, that would mean a Fed funds rate of the same. So that's what we expect, and that would signal a steady hand to sustain the groove without overstepping. And then we move on to legislative affairs. So a twist to the party is here comes the Trump accounts. On July 4th of this year, funding for Trump accounts begins, which were created or introduced as part of the One Big Beautiful Bill Act. It's important to realize how these Trump accounts can benefit minors. There are no income restrictions on setting up those accounts, so anyone under the age of 18 can have a Trump account. Anyone that is born in the year 2026 through the year 2028 will automatically have a Trump account and funded and seeded by the Treasury with $1,000. Otherwise, families can contribute, or anyone can contribute, up to $5,000 per year per beneficiary. And at age 18, these Trump accounts will turn into IRAs. There's more nuances to them, including investment restrictions and things of that nature, but very important, a new financial tool introduced here in 2026. Lastly, we have our financial planning corner. We're talking about Social Security optimization and why the right filing decision is rarely obvious. So Social Security has a lot of different options, and there's a lot of different opinions about where to begin Social Security, if you're married or were married, widowed, or even divorced after being married for 10 years. There are a lot of different options and scenarios to run through. So the first would be a break-even analysis, where looking at starting Social Security versus now versus later. Some things to keep in mind there are expected lifespan, investment returns, consideration of survivor benefits, etc. We would encourage you to look at our playbook online at andersonfinancialstrategies.com under our quarterly playbooks and read through this interesting piece put together by Matt Peck on our team to look at some of those optimized ways to account for Social Security. So here in 2026, we're really excited to continue to keep the party going and expect another solid year for the economy and portfolios.